Hi, everybody, and welcome to the weekly market wrap for January 19th, 2018. Once again, we are testing and breaking through, in a lot of cases, the all-time highs for the markets. We are in a position where we've been consolidating for a bunch of the last 4 days or so after gapping up to new highs on Monday. And to end the week, we obviously ended a little bit higher than where we gapped up on the open on Monday, and we're in a position right now where we have the government shutdown looming, which I think the media makes way more of a big deal out of this thing than it really is. It seems like most of the government's going to be open, a lot of them working, not getting paid, but they will get paid with interest at some future point when they do come to agreement in a week or 2 days or whenever they do. But it's 7 o'clock Eastern Friday as I'm recording this, and they haven't come to an agreement yet. So I'm assuming it'll probably at least go into the weekend. So uh, what's happening right now is that we just see this constant drive higher in the stock market, and with that comes a lot of people who are always looking to sell it and hope for a dip so that they could buy it cheaper. I don't see too many people out there, even if you are a bear and you're kind of thinking, hey, a 10% correction's around the corner, and that's possible, right? But I just don't see too many people that are saying this is the top of the market and this thing's going to retrace everything that it built up from 2009 till now. So there's not that crowd. So even if you're a bear, you're kind of a bullish bear. And if you're a bull, you just kind of think, hey, you know what? I'm not going to fight the markets and to keep on going higher. I'll deal with it when it goes down. And that's been the winning strategy, which is I'm not going to try and arbitrarily pick the top. I'm just going to let it run higher. And if I'm in at the top, so be it. At least I would have made 90% of the move on the way up. So that's kind of what's happening. So yeah, we are continuously going higher. We're consolidating a little bit. We're not at the same peak rate of ascension that we were for the first couple of weeks of the year. And if you take a look at just this is the hourly chart on the S&P ETF, the spiders. You'll see kind of the first part of the year. This is the 29th of December. This is from here, you know, this big uptrend for the first week and then the second week, and now we're kind of starting to level off a little, which is interesting because all these overbought signals on this red line below, this is the RSI, relative strength indicator. As this thing gets above 70, it's supposed to be overbought. But what happens is this thing is up in the $90 or 90 range, I should say. And then as the market kind of consolidates and trades sideways, then the RSI resets itself, and as we go higher, it starts to go up again. So the point is that these overbought signals, they can be reset just by trading sideways. So just because you hear things or see things that the market is overbought, don't necessarily mean that's a reason to sell or a reason to short. It just may be a reason for a pause. And I know we're looking at a smaller time frame with the hourlies, but even if you take it back to the daily candles, and let me just get rid of these lines here, you're still looking at a situation where I'm just kind of going back in time. You're still looking at a situation where we just have this big move higher and maybe a little consolidation in the middle and then continued. So we're in a spot where the market is telling us that there are more participants willing to aggressively buy shares than sell shares. Obviously, it looks high from where we've been. The market's up about 5% in 3 weeks to start the new year. So yeah, it looks high from where it's been, and it's been higher last year and higher the year before. So we're definitely in a position where if you look back, it looks like we're way too high, but there are fundamental things that have propelled this, like tax reform and good earnings. And one of the things that I thought that I wanted to mention again, because I think I have in the past, is that the amount of stocks that are available to buy in this market is about 3,300 publicly traded companies. Now, back in about 2007 or so, that number was up in the 5,000 range. So what we're seeing is a lot more money getting put into the market and a lot less stocks to put it in. So what winds up happening is the PE ratios for the companies that are left over that are getting the allocation of that money, they're the ones that are getting pushed higher. Therefore, the valuations seem higher because there's more money chasing less stock. So that's another kind of structural component to what's happening in this market. So what am I looking at? I'm looking at what the insiders are doing. I'm looking at the fact that the trends continue to go higher. Um, there's not much else to look at. I mean, we could talk about government shutdowns and North Korea problems um, and other things. But I think the true tell to this market is just simply price. Price continues to go higher, so you have to remain bullish. And if you don't, it's pretty painful sitting out. And I've gotten stuck a couple of times in this rally where it kind of felt a little bit bullish or a little bit neutral. Excuse me, a little bit bearish or a little bit neutral. And it's painful. The fear of missing out, which you may have heard of before, is just the fear that you're not going to be participating while everybody else gets rich. That's just as painful as kind of being in something that's going against you. So it's definitely a situation where uh, you're looking at this and you're kind of seeing that, you know what, let me participate because this may really be one of the best bull markets in the history of the stock market. And if that's the case, you can't judge it by how high it's been. You just can't. You just have to stick with what's working and hopefully it gets you extremely wealthy by doing so. So I hope you guys kind of take what I'm saying here and kind of think about it because it's really important to know that the market does not care how high it's been or where it's come from. The market only cares about future earnings, future valuations, and supply and demand. And if you put those things together, anything's possible. Market could go up another, 20, 30% over the next year or two. And one of the guys that I respect, his name is Tom Lee. He's been calling probably one of the best analysts on the street. He's saying that the bull market lasts until 2029. So I don't know if he's right or not. I mean, he's saying that the S&P 500, which is about 2,800 now, could go up to between 6 and 15,000, which is, phenomenally far away from here and higher. And I'm sure he's not considering that's going to happen without any type of correction. But my point is, you want to put all this stuff in perspective and say there were two super bull markets since the start of modern history when it comes to the stock market. One of them was in the roaring 20s, which you all read about, which led to the Great Depression. The other one was the internet bubble that we lived through for most of us, and some of us even participated in the late 90s, early 2000s. And both of those went way higher than people expected. And both of those ended with a pretty deep correction. So in the 1920s case, obviously depression, but in the 1990s case, we actually had, or 2001, 2000 was the actual top of the Nasdaq at that point, but that ended in a pretty bad recession. So yeah, the naysayers, you might be 100% right. This thing could end badly, but that doesn't mean selling, shorting here is the right move. Market could go up another 35% and then have a 20% decline, and you're still 15% higher than where it is now. So that's the problem with being negative in a market that's telling you that it wants to go higher. The problem is you may be right, and even if you're right, you're wrong because you have to time it correctly. The other way, if you're just reacting to what the price is doing, yeah, you may be wrong at the turning point, but at least you're in a position where if it does go lower, um, you have your stop losses in and they'll get us stopped out. And that's what will happen. I mean, even on the focus list, when you take a look at this focus list, if you have your stop losses in, like we do with the focus list, and the market starts to really take a tumble, you're going to see on the newsletter we're going to have four, five, six companies get stopped out, and they're all going to look bad, and everybody's going to think the newsletter stinks. But that's the newsletter protecting you in case the market gets crushed by 30, 40, 50%. It's getting you out in the case of a really bad correction. So that's what happens. So keep it in mind. It's possible, but until that happens, we don't worry about it. So we just keep on plugging away. We're doing good. And it's probably the longest video I've ever done, but kind of thoughts popped into my head as I was plugging along. And since we're going for the marathon video here, one more thing to mention: the the headwind that could be is the 10-year yield, which is about 2.64% on the U.S. Treasury bond. So what's happening is that interest rate is continuing to go higher. Now, I don't think that 2.64% is going to make anybody sell a stock and go buy a bond for 10 years so that you could get paid 2.64%. I mean, that's nothing, right? But if that goes up too quick, what I think can happen is that it may trigger the Federal Reserve to fight inflation or keep interest or actually increase those their own interest rates, or the Fed funds rate, I should say. And by doing so, that could really have a negative impact on the market. So that's kind of the boogeyman that's out there right now. We'll see if it comes to fruition, but hope you guys have a great weekend. I really tried to just kind of empty my brain into this video and try and come up with everything that I'm seeing, experiencing, and what we've been through in the past, and trying to put it into this. So good luck with everything. I will keep in touch. And so far, the insiders are buying. So far, the market's continuing to go higher. And we'll just react, not predict. Thanks.